Well, hey there, everyone. Hello. Happy Wednesday. Hope everybody's having an awesome week. I am super excited for today's workshop. So, we are here to talk all about financial statements, which I know doesn't sound like that sexy of a topic, but I promise you, I think this is going to be really valuable. Understanding your financial statements, and we'll talk about what those are. So, if you don't know what financial statements are, don't worry, we're going to get there. But understanding your financial statements in your business is one of the most important things you can do when it comes to really being in control of the money in your business. Your financial statements are really what help you understand the numbers and the money and what's going on financially. It's one of the best ways that exists for you to get that information. So I'm excited to dive in. Let me go ahead and share my screen. I always forget to do this. Hold on. I want to pull up my little iPad here so that I can see what we're doing. Give me a second. I'm never ready. I have a new computer, which is great, but it means, and Apple has changed up all the cords. So of course my normal plug doesn't work on my iPad, whatever, it's fine. I'm going to pull it up on my phone because I know we had a bunch of folks who were going to join us live today. So I want to make sure that I see you and I can answer your questions. So if you are here watching live and you've got questions, definitely drop them in the comments and I will answer them for you. Let's see. And if you are watching this on the replay, then I encourage you to come to our Q&A. We're now doing Q&As twice a month here in the membership. I'm really excited about that change. I think it's going to be just another great way to get all of your questions answered. So, okay. And I see we've got some comments. Hold on. So, hey, Mackenzie, I can tell who you are. Yes, thank you. All right, cool. And hold on, I got to make sure. Let me pull it up over here. I always like to pull it up just to make sure. But it sounds like, Mackenzie, you can see and hear me, so that's good. We're gonna get started. All right, let me share my screen. Whew, I haven't been live in a while, and so it's funny. I feel very, I don't know. I feel like all over the place. Let's get some prettier background. I kind of like that. That works for me today. Okay, understanding your financial statements. We are going to deep dive into the numbers that you need to know today. So let me bring it over here. What are financial statements? So there are three main types of financial statements that we're talking about when we're kind of talking about the financial statements you need to know. The first is your profit and loss statement. This is sometimes referred to as an income statement. It can also be referred to as a P&L, profit and loss. Very, very popular. This is one of the most important ones. The second is your balance sheet. Now, for most of us, balance sheets really aren't that important because most of our businesses are what we call cash basis businesses. I'm not going to go too far down the accounting method rabbit hole because nobody wants to hear about that. But basically, there are two different types of accounting methods that you can use, ways that you track the numbers in your business. The first is the cash method. And the cash method says that when you get money in, when you get sales in, you track them in your accounting system. And when you spend money, when you pay for something, you track that in your accounting system. The accrual method, on the other hand, says that when you earn or incur a sale, you track it, even if you haven't been paid yet, or if you've been paid, but you haven't earned it yet. So for example, let's just say I sell a 12-month coaching program and I sell it in December for the following year and somebody pays me $20,000 for that coaching program, or let's make it an easy number so I can do math, $24,000 for that coaching program. I get the $24,000 in cash in December, but I can't recognize, if I'm on the accrual method, I can't recognize that $24,000 of cash as income in December because I haven't earned it yet. It's paying for a service that exists over 12 months. So in reality, what will happen is I will recognize $2,000 every single month as income for the next 12 months, even though I've gotten the cash up front. Now, on the flip side, if I'm on the cash method, I'm going to recognize that full $24,000 the day I get it, even though I haven't delivered the service yet. So that's what the accrual method says, is we recognize revenue when it's earned or incurred, or really earned, not when it's paid. And then on the expense side, we recognize or report expenses when they're incurred. So if I put in a big order for, I don't know, like t-shirts that say I love tax, but I haven't paid for them yet, doesn't matter. It's still an expense of the business. It's a liability of the business that gets reported if I'm on the accrual method. So cash accrual. So if you're on the cash method, which most of us are, then the balance sheet isn't that important, because I don't want to say it's not important at all, but it doesn't have that many things going on, because on the balance sheet on the cash method is really just going to have what's in your bank account and what's and like what you've invested in the business. It's not going to have any liabilities on there, because again, we're not recording or tracking anything that we owe. We're only tracking what comes in and comes out, right? So balance sheet does exist in a cash method business, but it just doesn't have as much going on. It's not going to tell us as much. And then the last statement to be aware of is the cash flow statement. And I will tell you, going back to when I was in grad school and I was getting my accounting degree, this statement is confusing as hell. So we're going to look at it today, but I also don't want you to rely too much on this statement, because it confuses even accountants. And I don't think it's actually, the way that it's created, I don't think is actually the most useful. For those of you who have been around a while, you may know that I'm a big fan of my cash flow tracker, which is a spreadsheet. You all have access to it on the membership. And it's a fairly easy to use spreadsheet. I think it's easy to use. The downside is it's manual entry, meaning we've got to enter the numbers. The upside is it's very simple. I prefer that over a cash flow statement, but we're going to look at all three today. So, all right, let me come back over here, get my slides going. Oh, nope, too far. What do we do? I went really far. Okay, profit and loss statement, P&L. You're going to hear me say P&L a lot today. Mackenzie says, I'm going to remember cash is the immediate method. That's exactly right, Mackenzie. I got to get better at putting my comments on the screen here, but I love that. Oh, look, you've got like she's got her cute little running with bacon logo and her picture, everything. I like that. That's perfect. But yeah, cash is the immediate method. That's exactly right. It's the in-hand method, or it's the, if I've paid for it or I've gotten it in, then I'm recognizing it. Okay, so P&L, profit and loss statement, summarizes the revenues, that's money coming in, the expenses, money going out, and then the profits, revenues minus expenses equals profits, for a period of time. And we're going to dig in and look at exactly what this is, and what periods of time and all of that. But that's what a P&L is. All right, why is that not working? There we go. A balance sheet, on the other hand, shows the assets, the liabilities, and the equity of a business at a particular point in time. So assets are things like bank accounts, inventory, if you have a physical product-based business, furniture, fixtures, those are all assets. Liabilities, credit cards, loans. If any of you have those SBA EIDL loans, those are liabilities. And then equity, that's what you got in the business. That's what you've put in minus what you've taken out. So if we invest money in, but then we take money out, that's our equity, plus all the profits or losses of the business. That's equity, okay? So let's dive a little bit deeper into what assets are. Oh, you know what? Actually, sorry. Before I do that, I want to jump into the profit and loss statement. Before we get to the balance sheet, let's do the P&L. I forgot. No, we don't want to rate Canva's experience. Oh my gosh. Hold on. Stop screen. All right. Let me pull up. Oh, not ready. Not ready. Here we go. I had all these examples that I pulled down from my test account on my Wave account, or on my Wave system. So let me get these opened. And because I want to show y'all what a profit and loss looks like. Now, every accounting system looks a little bit different. So I'm going to show you, this is what it looks like when you pull from Wave. Hold on. But everyone looks a little bit different, but they all have the same features. Okay. So they're all going to have the same general features. All right. Why can't I find this? Hold on. There we go. Okay. So P&L, let's see if I can get rid of this screen here. So profit and loss. Now, the first thing you want to note is the date range. So this P&L is for this year, January 1st through July 11th. Of this year. Oh, good. Mackenzie uses Wave. So yeah, and I know a lot of you use Wave. So this is what you'll see when you pull a report. So the first thing you're going to see on your, and by the way, this is a single period report, meaning it's just for one period. I'm going to show you in a few minutes what a comparative report looks like when we're comparing two periods. And you want to do that. That's actually super helpful. But the first thing you're going to see, the first section you're going to see on your P&L is this section right here, your income section, okay? So this is where your income, your revenues are reported. Now, this is a test business. I've made these numbers up, But here I've got two different categories of income. I've got my sales of $14,600, and I've got non-taxable income. We're going to say that that was a like a PPP loan or a grant or something like that. That would be non-taxable income. So I've got total income of $19,600. Now the next section is cost of goods sold. If you do not have physical products, you will not have this section. This section is only for folks that have physical products to report the costs that are specifically related to creating the thing that gets sold. This does not apply for service-based businesses. I do know service-based businesses who treat their inputs like labor as cost of goods sold. That's not technically correct with the accounting rules. If you do it, it's not the end of the world. You don't need to go change everything, but it's not technically correct. So this is really just for physical product-based businesses. And your cost of goods sold are really the inputs that go into making what you sell. So, and I've used these examples before. Usually I have a notebook next to me. I don't have a notebook anymore because I've switched to my iPad. If I make straws and I sell straws, and I'm embarrassed that I have this because I'm usually very good about having reusable stuff, but this is on my desk for some reason. So if I make straws, inputs, cost of goods sold to make this straw that I'm going to sell might be the paper wrapper. It might be the plastic that I'm going to use to make the straw. Those would be cost of goods sold. Those would be the inputs that I had to purchase to then make the straw to sell to you. Okay, so that's the second section. Now, income minus cost of goods sold gets us down to a number called gross profit. That's basically saying, what is the profit before we factor in operating expenses of the business? Again, if you're in a physical products-based business, gross profit is a number that you're really, you really should be in tune with. You're also probably thinking a lot about what is your gross profit percentage? How much of your total income is profit? Okay. So in this case, my gross profit, I put a little bit of cost of goods sold in here. I've got some physical products in this fake business, but I had an income of $19,600. I had cost of goods sold of $75. So my gross profit, the $19,600 minus the $75 is $19,525. My gross profit percentage is 99.62%. Okay, so that's the top half of my P&L. And as I'm going through this, I'm going to go kind of fast. So let me know if you have questions or if there's anything you want me to go back and explain again. The second section of the P&L, the bottom half, are your operating expenses. Now, most businesses are probably going to have more categories than just 4, but this is a very simple business. So I've got 4 here. I've got advertising expenses of $1,000. I've got contractors, maybe my VA, maybe I've got a social media person of $2,500. I've got interest expense. Maybe I have a credit card that I didn't pay the bill and I incur a little bit of interest on. And then office supplies of $250. So total operating expenses of $3,800, okay? Now the last section, and I don't know why Wave bumps this to the next page. It doesn't do a great job of formatting this. But the final piece of your P&L is your net profit. So your net profit, just to go back up, is going to be this gross profit, which remember is your income minus your cost of goods sold. So gross profit minus your operating expenses. So we have gross profit of $19,525 minus our operating expenses of $3,800. That gets us net profit of $15,725. And Wave happens to tell us that that is 80% of our total income, which is a good number to know. You want to know what your net profit percentage is. You want to know for every dollar you take in, how much of that dollar do you actually get to keep? That's what net profit is. It's what you've got left after everything's been paid. So 80% is a pretty good net profit percentage. I would take that any day. Most businesses are not going to be at 80%. They're going to be much lower than that. But if you are like a digital products-based business, you might actually be closer to that percentage because your overhead is really low. Okay. That's the P&L. That's what the P&L shows you. Now, what are some things, hold on, let me stop my screen for a second. I want to just remember real fast what order I put these slides in because I want to show you all a comparative, but I don't want to jump too far ahead. So give me 1 second. Yeah, I'm going to wait. Okay. So we'll wait to do a comparative for a second. So the next one I want to show you. So before you, Mackenzie says I take 80% profit for sure. I would too, any day. I'm going to dive into the balance sheet stuff next. Before I do that, if there are any questions about P&L, drop them in. I can always go back to the P&L statement. Oh, you know what? I do want to show you one other thing actually. a lot of times people ask, okay, so what do I need to pay attention to on my P&L? Like, what do I care about? Now, I will tell you, most of what I pay attention to on the P&L comes from actually doing a comparative P&L, which is comparing multiple periods. We're going to look at that in a few minutes. But I do still pull my regular single period P&L very regularly. In fact, I pull this twice a month when I do my money meetings. And I look for a few things on my P&L. So the first thing I want to look at is my income. How much income have I had come in? And that's important to me because I also do a budget for the year. So I map out, I list what my financial goals are. And then I map out how I'm going to hit those financial goals. And that's all in my budget. And so I want to see where my total income is at because I want to know if I'm on track to hitting my goals. Now, total income is just one component of my budget. So I could hit my total income and not hit my goals because my expenses could be too high. But it's one piece of that puzzle. So I want to know what my total income is. The other thing I want to know in the income section is how does that income break out? This is not a great example because I only have 2 items here, and one of them we're basically saying is a grant. But if you look at the P&L for actually my business, I have tax prep, I have S Corp elections, I have CFO services, I have Badass Moneymakers, this membership, I have strategy calls. I've got all these different types of revenue sources in my business. I want to know where's the money coming from? Where am I getting the majority of my income from? Because it's important to know what's juicing in your business and what's not. I don't even know if that's a word, but I use it. So the second thing I want to know is, and again, this is for my physical product-based business owners only, but what is my gross profit? What does that look like? So if my total income is $1 million, but my cost of goods sold are $999,000, that's not very good. I'm not going to survive very long on that, right? On the flip side, if my income is $1 million and my cost of goods sold is $100,000, hey, I'll take that. Physical product-based businesses will probably take that any day because that is a great gross profit of 90% of your income being your gross profit. Okay, so that's what I'm looking at is where's my cost of goods sold at? How much of what I'm taking in do I have left over after I've paid for the inputs to make the thing I sold? How much do I have left over? The third thing I want to look at are those operating expenses. So are there expenses that feel really high? One of the things I often notice, especially in newer businesses, they spend a lot of money on training. So one of the things we'll look at is, well, how much have you spent on training compared to how much you're bringing in? Is that maybe a little high? Do we need to scale that back? But I like to look at all the different categories and just get a sense for where my money is going. I would expect to spend more money on contractors, on salaries and wages for folks. Perhaps on advertising, that's probably going to be a big expense for my business. So that's where I want to see my money going. If I'm seeing a lot of money go towards interest expense, or if I have a huge number in office supplies, I don't have a physical, I work in my home office, but I don't have a physical office. So I wouldn't expect in my business, my office supplies to be that high. So I'm going to look at that kind of stuff and see what feels right and what doesn't feel right. And then the last thing I'm going to look at is that net profit. Number one, is it a profit? Am I actually in a profit position? And number two, how much of every dollar I take in ultimately becomes profit? As Mackenzie and I said, we take 80% for sure, no question. Again, not probably super realistic for a lot of businesses, certainly possible. But is your profit percentage 1%, 5%? What is it? Now, I've mentioned comparative financial statements several times now, which is where we compare 2 periods. A lot of these numbers are going to be more valuable to you when you're comparing them period over period. For example, there's no magical net profit percentage we're trying to reach. What we are trying to do in theory is increase our net profit percentage so that over time we're making more money from every dollar we take in than less. So we want that comparative profit financial statement to kind of show us that. But even standalone, this can be really helpful because it does give you a good sense of where the numbers are in your business, where the money's coming from, and where the money's going, okay? And again, let me know if y'all have questions as I go through this. So I want to pop back over to the, not yet. I want to pop back over to the balance sheet. Hold on. All right. I swear we're going to get this. It's going to be great. I'm actually just going to do screen 2 so that I can switch easily. So our balance sheet, I already mentioned this before, but it shows the assets, the liabilities, and the equity of the particular business at a particular, of the business at a particular point in time. So unlike the profit and loss statement, which covers a period, January through July, the entire year, a month, the balance sheet is a screenshot of a moment in time. Now, there are multiple categories on the balance sheet. I've already talked about these a little bit, but the first category, assets, that's what you have, okay? So assets can be divided into a few different subcategories. First and foremost, current assets. Current assets are things that can be converted to cash or are cash within 1 year. So this is going to be your bank accounts. It might be a money market account. If you have any bonds that come up within a year, that would be a current asset. The next group are fixed assets. So these are assets that you didn't buy to resell. You bought to keep, for example, office furniture. My computer is a fixed asset. If you own a building in your business, that would be a fixed asset. These are items that get depreciated throughout their useful life. Depreciated is a fancy term for deducted on your tax return. But instead of deducting the full cost in the year that you buy it, you divide that deduction out over what's called the useful life of the asset. So the useful life of a building is a lot longer, 39 years, than the useful life of software, 3 years, okay? It's over time. Now, the next section are liabilities. So liabilities have similar structure to assets. You've got current liabilities. These are things you owe. So these are debts that you owe that have to be paid within a year. So these would be things like credit cards. If you buy like inventory, and they give you 90 days to pay for it, that would be a current liability. Any kind of short-term loan would be a current liability. Long-term liabilities are paid over a longer period of time, so a year or longer. So that would be like a mortgage. It might be the SBA EIDL loan if you got those. They're going to last more than a year. And then the last section, equity. Equity equals your assets minus your liabilities. Equity is what you have in the company. Now, equity does not always mean cash, by the way. Well, it does. It does in a cash basis business, because in a cash basis business, you're not going to have any liabilities because, again, we're only tracking things when we actually pay the cash for them. But in an accrual-based business, equity does not always mean the same. Equity is not always going to be the same number as the cash you have. Okay, so in a cash basis business, that is the case, not the case in an accrual business. So I want to talk about some equity accounts first. Now, again, most of these are going to be more relevant or more complex if you are an accrual-based business than if you are cash-based. And I'll try to speak to that as I go through. So the first category in the equity section, and this is, by the way, I'm going to do this by entity type. So the first group I'm going to talk about are my sole proprietors or my single member LLCs, meaning you're the only person who owns your LLC. So the first equity account you're going to have is what's called owner's capital. Sometimes it's called owner's investment. Like basically some account to represent what the owner puts into the business. And that's exactly what it is. It's the cash that the owner puts into the business. So if you start your business and you deposit $5,000 in your business bank account from your personal funds, that's owner's capital, owner's investment. The second equity account for these folks is owner's draw. So this is cash the owner takes out of the business. Now, what I see some people do sometimes is just use the owner's investment account to report cash in and cash out. But in theory, most accounting systems will create two accounts for you, owner's capital and owner's draw. So owner's capital is cash going into the business. Owner's draw is cash coming out of the business for the owner. And then the last equity account is retained earnings. This word's going to come up a lot, so remember this one. Retained earnings are your accumulated profits or losses. So if you make $20,000 in profits this year, you're going to have $20,000 of retained earnings, and it accumulates over time. So every year, your profits and losses get added to the balance that was in there before. I know that's a lot. We're going to look at balance sheets, so don't worry if that feels really overwhelming. Now, if you're a partnership or a multi-member LLC, this is going to change a little bit. So you're probably, instead of having an owner's capital account, you're probably going to have a partner's capital account. Now, if it's a multi-member LLC, you could still have owner's capital, but you're going to have accounts for each owner. Okay, versus just one owner's capital account. And again, it's the cash that the partners or the owners put into the business. Same thing with the partners draw account. It's the cash that gets taken out of the business, but it's going to be per partner, right? You're going to have one for each partner. And then retained earnings, same thing. We already talked about that. Okay, if you are a corporation or an S corporation, you're going to instead have a capital stock. And by the way, when I'm saying S corporation here, I'm talking about S corporations that started as corporations, not S corporations that started as LLCs. Okay, those would be the rules that we just talked about. So if you're a corporation, you're going to have, instead of owner's investment or owner's capital, you're going to have capital stock. Because remember, the difference with a corporation is it has shares. It sells shares to people, and that's how they buy into the company. So capital stock is stock that is sold to create or fund the business. There's also going to be a shareholder distribution account. This is cash that comes out of the profits of the business that gets paid out to its shareholders. And then again, we're going to have that retained earnings account that exists in every business type. So before we get to a cash flow statement, let's go ahead and look. Hold on, let me get out of here. Let's go ahead and look at what our balance sheet looks like. So this is our balance sheet as of December 31st, 2020. Remember, a balance sheet is a screenshot, like a snapshot in time as of a particular date. So the first section of our balance sheet is what? It's those assets. So notice it says assets right up here. And it does break it out into cash, other current assets, and then long-term assets. So in this case, we've got $5,750 in our checking account. That's a current asset. We've also got inventory of $250. That's another current asset. Inventory is considered a current asset because the expectation is that you will sell the products you have in inventory sooner than a year. Now, again, inventory is something only physical product-based businesses will have. And in my example here, we don't have any long-term assets. So in this case, our assets are $6,000. Now, in this particular case, and I'm going to do a little bit of a disclaimer here, but I have a cash basis business, okay? But I like to keep a balance sheet that effectively works on an accrual basis because I like to see my liabilities. I like to see what's going on in the business that isn't just reliant on the cash. So in this particular case, what we're looking at here is a balance sheet that is effectively assuming we're an accrual-based business. That was what I said was probably really confusing, and don't think too hard on that. Just know that, especially if you use something like Wave Apps, and actually, sorry, even if you use like QuickBooks, you can absolutely pull a balance sheet and it's going to show these items on here, okay? So in our liabilities section, no current liabilities. Let's just say I don't have any credit cards in the business, but I do have a long-term liability of a PPP loan that I took out. Now, what was I going to say? I'm going to show you, in fact, this is a balance sheet as of December 31st, 2020. I'm going to show you a balance sheet as of like July, whatever, for this test business, because that PPP loan is actually going to get forgiven. It's going to come off the balance sheet, but I'll show you that in a second. But I got this liability of $5,000. Now, remember, I had assets of $6,000, okay? On a balance sheet, your assets must always equal your liabilities and your equity, okay? Assets must always equal liabilities plus equity. So we have $6,000 of assets. We only have $5,000 of liabilities. We're out of balance until we get to our equity section. And in our equity section, we've got $1,000 of owner's investment. I put $1,000 into the company. That's how we get to our $6,000 on the liabilities and equity side, which balance with our assets of $6,000. Now I want to show you the balance sheet for, it says December 31st, 2021, but it's really whatever date I pulled this, July 7th or whatever date it was. Okay, again, this is the test business. We got our checking account here, 20 grand in our checking account. We've got a little bit in our inventory. So our assets of $20,525. Oh, now we have a credit card in the business. So we're going to put our credit card here in our total current liabilities. We owe $1,250 in that credit card. So that's going to show there. The PPP loan has come off because we got it forgiven. So it's no longer a liability. Cool. That's off the balance sheet. But, oh, we did go ahead and get an SBA EIDL loan. So that's on our balance sheet. We've got to pay that one back. Okay. So we've got liabilities of $4,050. Now remember, assets of $20,525, liabilities of $4,050. Those don't balance. They're not the same number. We're off by about $16K. Lo and behold, let's look at our equity section. We've got owner's investment or drawings of $750. This is an example. I should point this way. Nope. I don't know how to do the camera. This way. This is an example of where the owner's investment, owner's capital, owner's draw account is combined into one, owner's investment and drawings. So owner's investment in and owner's distributions out go into that same account, but you could have them separate too. It's $750. It was $1,000. So we must have taken $250 out of the company. We also have our retained earnings. Now, this is the first year that the business had any income. So notice how our retained earnings amount of $15,725 breaks out into just this one item, profit between January 1st, 2021 and July 7th, not December 31st. It hasn't happened yet, but July 7th of 2021. So that's the money we've made so far, $15,725. And notice if we go back to our P&L for the year, that's our profit, $15,725. So that carries over to our balance sheet here. And that gets us total equity of $16,475. And so our total equity of $16,475 plus our liabilities of $4,050 equal our assets of $20,525. Make sense? Now, one thing I will show you, let me stop my screen real fast, because I know we've got a lot of Wave Apps users in here. So I'm going to show you this on Wave Apps. This is going to be different on every accounting system, but I want to show you if you want to pull a balance sheet on Wave Apps. Now, remember, I said a few minutes ago, if you are a cash basis taxpayer, technically you would not record things like your loans. You don't have to because they're not, you haven't paid for them yet, okay? We don't record things like that until we pay for them. But this is where I appreciate having an accrual-based balance sheet because I think it's helpful as a business owner to be able to go into my Wave account and see that I owe an SBA EIDL loan of $3,000. So when I do my bookkeeping, I do enter in loans. I enter in my credit card balances because I think that's important to track. Technically, when you're on the cash basis, you're not required to track that. It's up to you. But I do want to show you when you're in Wave, something that you may not have noticed before, and I think is important to be aware of. So this is my test business inside of Wave. So when I'm over here on the left, and again, any accounting system is going to have something similar. I'm going to click on reports and I'm going to go to my balance sheet. Now notice up here at the top, you may not have noticed this before, there's a report type and you can actually choose accrual, paid and unpaid, or cash basis. Okay. Now in this case, it doesn't, Wave is not going to remove. So I've got my credit card, my EIDL loan. If I choose cash basis, Wave isn't going to remove it. Remove those items. They just show you the same either way. But I just wanted to point that out. It's going to be the same if you go into reports for P&L. You're going to have that same option as well. Okay. But the alternative would have been, let me come back to my balance sheet real fast. So let me come in here to my EIDL and hopefully, nope, it's not going to show you that screen because I didn't share the whole thing. Hold on. Okay. Bear with me. Sorry. Screen 2. Okay. So when I got the EIDL money, here's how I recorded it in Wave. So the proceeds came into my bank account, $3,000 in. Excuse me. And let me actually click this open so you can actually see the entry I did. So, okay, so proceeds came into my checking account and I recorded them to SBA EIDL, which is a liability account. If I didn't want to track these things on my balance sheet, then I wouldn't need to record them to that account. I could just record them as, loan proceeds or something coming in that's a non-taxable item, basically. But like I said, I find it really valuable to have that balance sheet show those liabilities. All right, now what I also want to show you, actually, let me go back to the slides real fast. That was balance sheet. Our next thing on our slides is actually cash flow. But before we get to cash flow, I want to, I'm going to skip out of order a little bit here because I want to show you, I want to talk about the financial statement periods and I want to show you what that looks like on both the P&L and the balance sheet. So let me share my screen again. All right, screen 2, here we go. So financial statement periods that you can have these things for. You can have financial statements for a period of time, such as the year, that would be your P&L. You can have them for a snapshot in time on a particular day, that would be your balance sheet. And then you can also have comparative financial statements. So basically comparing one period or one date to a second period or a second date, okay? So I want to show you what this looks like in both cases. So let's look at, I think it's this file. Yes, perfect. So this is the P&L. It's a comparative P&L for two periods. It's comparing 2021 year to date with the entire of last year. Now, actually, this is a little unfair because generally you want to compare similar periods. So if I actually wanted to compare the profits and losses of the business this year to the profits and losses of the business last year, I'd want to compare January 1st through July 11th, 2021 to January 1st through July 11th, 2020. I want to compare the same periods. But in this case, I didn't do that. I pulled these quickly and I pulled the whole period. Now, in my test business, we didn't have anything going on last year. So this comparative P&L isn't that exciting. But what's cool about it is that you get to see what the numbers are in each year. So you can tell, well, has my income gone up? Which income streams have gone up? And not only does it show you the change, so how much it's gone up or down year over year, but also the percentage. So how much has the business grown? This is what's great about comparative profit statements. Thanks so much, Mackenzie. Sounds good. So that you can do the same thing with your cost of goods sold categories, and you can do the same thing with your operating expenses. I really like to do this with operating expenses because I like to see, so, and again, this isn't a great example because I don't have any income in last year in my example, but I like to see, okay, my income, let's say my income's gone up 20%, but my expenses have gone up 40%. I don't want to see that, but I want to be able to know it. I want to be able to see that it exists so I can fix it. So that's what's great about the comparative financial statements. We can do, and we can see our profit there as well. So our profit this year, 15,725, last year, no profit. What is the change? What's the percentage difference? We can do the same thing. That's our cash flow. Hold on. It's going to be this one. We can do the same thing with, nope, maybe I didn't pull it actually. I did not pull it apparently. I thought I had pulled a balance sheet. Actually I did not, because frustratingly Wave does not let you do comparative balance sheets. It's really annoying. I don't know why. I'm hoping they roll that feature out because you should be able to, but they do not, for whatever reason, let you do that. I do want to show you though, how to pull this up if you are in Wave, how to pull up the comparative profit and loss statement. So we're here. Update our report. And when we choose this, so this is 2021 through today, we can choose this button here that says compare to a prior period. So we click that. And again, I would want to choose the same period, and it's automatically going to populate that same period for you, by the way. So that's what I'd want to choose. But you can also choose a different period if you wanted to compare something else. It's also really helpful, like if you want to compare first quarter of this year to first quarter of last year, you could do that as well. But for right now, we're going to just do, and again, my test business didn't have any activity last year, so this is not that exciting, but this is how you pull it. Okay, and you update the report. And so notice that it gives you all the information here, and then you can click details and you can see the details there. Okay. All right, so I want to go back now. So that's the P&L and the balance sheet. I want to go back and talk about the cash flow statement. I already prefaced this by saying I hate the cash flow statement. I don't find it that helpful, but nonetheless, I do want to help you understand it so that you have it accessible to you as one of the financial statements of your business. So it'd be good if I shared my screen. Hold on. Okay, so cash flow statement is a summary of cash and cash equivalents. Cash equivalents are things that can be converted into cash very quickly that enter and leave the business, all right? Excuse me. Oh, nope, that's not what I want to do. I want to show you cash flow. So let me show you, if I can find it, our cash flow statement. So this is a cash flow statement. I'm actually going to zoom out a little bit because more than any of the other ones, that might be too small. That's a little small. More than any of the other ones, the cash flow statement is one where you really kind of need to see the different components together. Let's see. Let's see what 75% looks like. No, that's even smaller. Oh, good Lord. Whew. All right, hold on. All right, hopefully you can actually see that at home, but it's not but you can also see everything you need to see. So, okay, cash flow statements like P&Ls are for periods of time. So this is for January 1st, 2021 through July 11th, 2021. And they have 3 sections. They have operating activities, which is this top one. They've got investing activities and they've got financing activities. We're going to talk about each section. So operating activities are just like they sound. It's the operations of the business. So this is going to be money coming in for sales. It's going to be amounts going out to pay contractors, to pay for your operating expenses, to pay for your inventory, your cost of goods sold, and all of that. And as you can see here, they've got some sections. At least Wave does this. Again, every accounting system is different, but they've got some sections for all of these things. So they've got a sales section. So there's our $14,600 in sales. Notice how remember we had like $5,000 of a grant, I think it was. Notice how that's not up here. That's not an operating activity. That's a one-off type thing. Unless your business is in the business of getting grants, that's not an operating activity. They've got a section for purchases. So this would be anything that we actually paid money for. So we paid for some contractors, we paid for some interest expense. These are things we actually paid cash for. Inventory, if we had bought any inventory, we didn't buy any inventory in this period, but if we had, it would be in here. If we had paid payroll, sales taxes, and other. And so then the net cash from operating activities is $12,050. The goal is to have that be positive, although there are situations where it's negative and that's okay. But the goal is to have that be positive, and it gives you a sense of how much cash do we have, once we've taken in sales and we've paid what we need to pay. The next section are investing activities. So if you have buildings or any other types of investments, they would go in here. This business doesn't do that. Your business probably doesn't do that either. So you're probably not going to have anything in this section. And then the last section is financing activities. So these are loans and lines of credit. These are amounts that the owners invest in the company. They are amounts that get paid out to the owners of the company. They are grants that come in. They are loan funds that come in. All of that's going to get put here. And actually, these items probably should be up in loans and lines of credit. They're not, just because of how I classified some things, but they are in the right section, at least, of financing activities. And so net cash from financing activities is $2,550. We took in loan funds of $2,800. We paid out $250 to the owners. So then finally on the cash flow statement, we look at, well, what's the total answer? And we look at the starting balance of cash that we had in the business. So in this case, $5,750. That was our bank balance as of January 1st, 2021. How much cash came in total? $17,605. How much went out? $3,005. So our net change was $14,600. That's not bad. We had a lot of cash come in and not a lot of cash go out. And so then that reconciles with our ending balance, because we have our starting balance of $5,750. We added $14,600 net. That gives us an ending balance as of July 11th of $20,350. So this is the cash flow statement. Now, I said before that I think cash flow statements aren't that helpful. And the reason I say that, it's not that they serve no purpose. They're helpful in the sense that looking at them can give you a sense of if your business is cash flow positive or negative. Excuse me. And what cash is coming in from operating activities, which is where you want cash to come in from, versus financing activities. So if you go out and you take a bunch of, do a bunch of like lines of credit on get cash from lines of credit on your credit card, you might have a lot of cash coming into the business, but it's not necessarily free cash, meaning it's cash you got to pay back, right? So that's why we want to put more reliance on cash from our operating activities, because that's cash in the door that you don't have to pay back to anybody, versus cash from financing activities. So this is a good first step, but what I prefer to have my clients do is, instead of looking at the cash flow statement, or instead of spending much time on it, is using a cash flow tracker. And in fact, I hadn't planned on showing you all this, but I will, assuming I can pull it up quickly enough, because I think it can be valuable to look at. Let me think about where this is. To look at how I use this in my business. Now, I'm not going to show you mine because it's a hot mess, and because it's got some confidential stuff in there, but I am going to show you the template, which you all have access to. Nope, that's not it. Oh boy. Here we go, cash flow template. Okay, so let me share my screen again. All right, so this is the cash flow template. You all have access to this. And I want to get this. Hold on, let me get these things out of the way. Okay, there we go. So there's 2 tabs here. There's monthly and daily. Now the monthly tab is going to operate very similar to how the cash flow tracker in Wave Apps operates, where it's just going to kind of show you high level. I include the monthly tracker in this document because for some people doing the daily right at the beginning is just too much. So if that's you, you can use the monthly. But to be honest, if you're using a tool like QuickBooks or Wave Apps, you already can pull a monthly cash flow. Not this detailed, but you can in the tool, and it's basically pulling the cash flow. In fact, are y'all going to see? Yeah, there we go. It's basically pulling, if you're in Wave, going to cash flow, and instead of having it be the year, just have it be for the month, right? Okay, so that's basically the same thing as the cash flow tracker without you having to do the manual entry. But the tab that I like in the cash flow tracker is the daily tracker, okay? Now, again, you have to do this as a manual input, which is kind of annoying, but I do think that this is a good tool to do. And the way I do, I'm not gonna go into exactly how I do everything because we've got a video on this in the membership. But the way I do it is I create 3 of these, one for each month, and I basically always keep a rolling 3-month tracker. And what I like about this over something like the cash flow statement or even the monthly cash flow tracker is having it done daily allows me to see if at any point in the month we go negative or low. I would not see that on a monthly tracker. What I mean by that is, let's just say you have $20,000 come in 1 month and you pay out $10,000. The net is $10,000. So if you looked at that on a monthly basis, you'd go, great, I'm $10,000 cash positive, fabulous. But what happens if you don't get that $20,000 until the last day of the month, but you've got to pay the $10,000 on the first day of the month? All of a sudden, you're $10K negative at the beginning of the month until you get that $20K. So that's why I like that daily tracker, okay? Again, we've got a whole video on that in the membership, so I'm not going to go into that more in detail. So I'm going to share my screen one more time. I want to just go back to this screen where oh boy, hold on. Okay. Where I summarized the 3 financial statements. And I know we went through a lot today. This was a lot I threw at you. We're going to do, in fact, in our money meeting sessions, which is the brand new feature of the membership I'm super excited about, we're going to do a lot more digging into these numbers, which is why I kind of kept this high level today. I really wanted today to just be about you understanding what these are, understanding that they exist, understanding what they are, what purpose they serve, and starting to get comfortable with them. Come to the money meeting sessions. That's where we're really going to dive into these in more detail. For anyone who feels brave, we're going to pull up your P&L. We'll pull up your balance sheet. We'll talk about it. But hopefully this helped give you an overview of these 3 statements. These are the 3 financial statements in your business. These are important. They're important for you to be looking at on a regular basis. They're important to have for tax purposes. They are important if you ever want to sell your business or get a line of credit, or for folks who got the loans like the SBA EIDL or the PPP. Depending on your business, you may have had to show these statements. So these are really important statements to have in your business and to understand what they mean. And most importantly, they give you really important information that you can use to make better decisions about your business. So I'm going to leave it there. I want to check. I know we've got, I'm just looking at some of the questions. I've got some questions over here on YouTube. Okay, I answered that question, so we're good there. Sorry, just bear with me. I'm just reading through these questions. And for folks who are watching live, if you've got any questions, this is the last chance. So not last chance, but last chance while I'm here live. So let me know. And I'm just checking over here on YouTube. Someone says still a little confused by the accrual thing. But I really just need to look at mine. Yeah, so here's what I would say. And the cash accrual thing is confusing. And it's one of these things where I'm like, anytime I have to talk about it, I'm always like, oh, because I know that it's one of these things that is hard. It makes sense high level. It makes sense in theory. Like Mackenzie was saying earlier, in fact, I'm going to bring her comment back up. She said, I'm going to remember cash is the immediate method. 100%. Like it makes sense high level, but then when you start getting into your actual numbers and your accounting, sometimes it can get a little confusing. What I'm going to recommend for anyone who's struggling with that concept is come to the money meeting sessions and let's actually like dive. It doesn't have to be your numbers. I can pull up a fake balance sheet or whatever, but let's actually look at it and talk through kind of some of the confusion. Because I think doing that more kind of one-on-one and when I can show examples is going to be a lot easier. Someone else asked, how do you know if you're on the cash or accrual method? So most businesses are on the cash method. By default, you are on the cash method. This is kind of a complicated question because it depends on your entity type and a few other things. I'm just trying to think how to make this as simple as possible. So first and foremost, if you have physical inventory, you are probably going to be on the accrual method or a hybrid method where some parts are cash, some parts are accrual. If you are a service-based business, digital products, whatever, don't have physical inventory, you're on the cash method. Until you hit a really high amount, and I mean like $25 million of revenue, you're on the cash method. There are requirements if you're a corporation. Most corporations are required to be on the accrual method. There are specific, like certain requirements there. But for most of us, you're on the cash method. And there's nothing you have to do specifically. Like you don't have to tell anybody you're on the cash method. You're just kind of automatically on it. But that said, if when you file your tax return, and this is not for my sole proprietors or my single member LLCs, because this is not a question on Schedule C. But if you're like an S Corp or partnership or corporation and you file a tax return, if on that tax return you checked the box that you're on the accrual method, then congratulations, you're on the accrual method for tax purposes, whether or not you wanted to be. And there are specific rules around whether or not you can change that. So if you're like, oh shit, I did that and I didn't mean to, there are specific rules around how to change that. If you can change that, there's oftentimes a waiting period of several years before you can change it. So if that's you, talk to your accountant, or if I'm your accountant, call me, we'll talk about it. We've probably already caught it if I'm your accountant. But those are the only people where you would ever have indicated to the IRS that you are on that method of accounting. Otherwise, most folks, it's not a question on Schedule C. So you're mostly on the cash method. The only other thing I will say is, and this is going really deep into the world of you don't really need to know this, there have been instances, there are fairly rare circumstances where for book purposes, but we mean accounting purposes, you're on one method. And for tax purposes, you're on a different method. That is not going to be any of y'all, so don't worry. But for the one rare exception, that could be it as well. Okay, I don't see any more questions over here on YouTube. I think we're good on Facebook, so I'm going to end it there. As a reminder to everyone, we are now doing 2 Q&A sessions every single month, the 2nd and the 4th week. And I'm going to confuse the schedule because I'm just going to confuse it. But the schedule is always available inside of our member portal. You can actually, we have set it up now where you can actually download it and sync it with your calendar, which is great. And so typically the way we've tried to structure this, I'm going to pull it up now and see if I can tell you. But the way we've tried to structure this is that we've got 2 separate times for the Q&As every month so that hopefully you can attend at least one of them. And then same thing for the workshop and the money meeting session, that we do them at separate times so that hopefully you can attend at least some of the things. So week 1 is going to remain the workshop. Weeks 2 and weeks 4 are the Q&As. Week 3 is the money meeting session. Anytime there's a 5th week, we're just not going to have anything that week. This is the only month where we combined the workshop and the Q&A today, just because of rollout and stuff like that. So we're actually going to do our money meeting session next week, which is the 3rd week of July. So I'm going to leave it there. Hopefully this was helpful for folks. If you've got questions, please submit them for the next Q&A session that we're going to have. And I hope you all have a great week. I'll see y'all later.